Hey, Colorado Springs, Chris Lopez here and Jenny Bayless to do a deal analysis, but not the typical deal analysis we've been doing. This will actually be a return on equity analysis on one of Jenny's properties. So you often hear us talk about deal analyses where we analyze a recent rental property that either one of us or our clients have purchased. Now, what the return on equity analysis is, it's a way to measure the property's performance and also how much return you're making on the equity on the property after owning the property for a couple of years to longer. Because after you've owned a property for a few years, using that initial analysis for when you bought it is not the best way to analyze a property. So Jenny and I have talked about this a lot because we have lots of clients saying, hey, I've had this rental for 3, 5, 7 years, or this property for this long. What should I do with it? Should I keep it? Should I sell it? Should I pull out cash? And this is exactly what the return on equity analysis does as well. And Jenny, you were gracious enough to put on one of your properties. So is this a property you're doing just for the sake of the podcast, or are you actually considering to make some moves with it?
Mostly for the sake of the podcast, because, in the back of my mind, I've thought, hey, there's probably a good amount of equity in this property. I should just kind of see what my options are. Personally, this is a super simple property that we've bought. I probably spend on average like 5 minutes a month on this thing. So it's really easy for me to just leave it be, but I should probably be more active in understanding what my options are.
Okay. So this is a 1970s detached single-family residence in central Colorado Springs with 3 beds and 1 bath and a 1-car garage. What did you purchase it for?
110,000.
And when was that?
2017.
And then just for simple tax stuff, we'll kind of keep it at 78% for structural value or for
Sounds
improvement
good.
value.
Yep.
Okay. Tax rate will keep at 25%. These numbers just help calculate some depreciation benefits. Now, okay, you bought this about 4 years ago. What do you think it's worth today?
So in its current state, I could probably sell it for 230, 240 with the market the way that it is. If I were to put about 15 to 20,000 worth of cosmetic rehab, I think I could probably get north of 280.
Okay, so sell it as is between 230 and 240. So how about we split the difference at 235?
Sounds good.
Okay, and then we'll come back and actually run a scenario of if Jenny were to sell it. I mean, spending $15,000 to $20,000 to make an extra $40,000. I
Definitely
will
worth
give
it.
you a $1 bill to get back a $2 bill all day long, Jenny. If you ever want
Yep.
to bring a couple briefcases together. So we'll run it at 235 today. What's your loan balance?
116,000.
So you must have refied this at some point because your loan balance
Yeah.
is higher than your original purchase price.
Yep. We did a burr once upon a time on this one.
Okay. And what is your monthly or annual rent?
1,100 a month. So it's well below market value.
Okay, so that what is market rent?
Ooh. So if we were to put that rehab amount in there, I would probably say 1450 a month.
What about with no rehab?
Probably 12 to 1250.
Okay, so we'll say 1250. So I think for the sake of this, to kind of keep it a better analysis, is I'm gonna bump up this to that 1250 market rent for as is. That way we can kind of get, because I mean, whenever the leases turn up, whether it's a month or 6 months, I'm assuming you could bump it up to market rent at that 1250.
Sure.
Is that a reasonable
Yeah.
assumption? Okay. And then
Yeah.
we'll come back and we'll change to the higher numbers with the improved on there. So vacancy, we'll say 3%.
Yeah.
Property
It's actually,
taxes.
well, I don't know if this matters for your analysis. I think 3% is good for long-term analysis, the city as a whole, but on this particular property specifically, we've had 0 vacancy because it's been the same tenant the entire time. So I don't know if that matters for this purpose.
I tend to like to run it at like kind of like more normal numbers because
Okay.
as we compare that with like the options on it, we try to kind of keep it apples to apples.
Okay.
But But yeah, I haven't really thought about that. What about property taxes?
600 a year.
600 a year. Insurance?
900 a year.
900. Property management is 0, right?
Correct.
Okay. Now, this is another one we can delete on the spreadsheet. Oh, and I forgot to mention, so we're this would have helped if I said this 5 minutes ago. We are currently have up on the screen our return on equity analysis spreadsheet. I've used this in numerous podcasts and blog posts. Jenny's used it with a lot of clients as well. So it's a great spreadsheet we put together to help run analyses. So this is something that you can come to your screen to view it, or also we'll put in the blog post and describe it as we plug it in as well. But that's actually what we're typing into. So for repairs and reserves, I mean, running at what, 5%, 8%? What do you like?
I mean, I think 8% is fair. In actuality, this particular home has been a lot less, but I think 8. If we're doing it as a overall percentage, I think we should do 8.
Because I mean, eventually over the 10, 20-year period, we should probably see averages like we're putting on here.
Yeah.
And are there any other expenses that we need to put into here?
No.
Okay. So for your financing, what is your current interest rate?
4.375.
4.375. Okay, and then your annual mortgage payment, or your monthly mortgage payment?
Yeah, 600 a month.
600 a month. And how much about that do you think goes towards debt pay down?
175-ish.
Okay. And we'll just keep appreciation at 3%. Again, that way, if we keep this at 3%, the other properties we remodel will keep at 3% as well, just kind of keep things apples to apples.
Sounds good.
Now, for the cash out refi, we've got a term in here that we often don't talk about, Jenny, which is this debt coverage ratio, which is more of a commercial, lending term that commercial lenders use. But the reason we put this in here is because what we've seen for a lot of properties up and down the front range is that when properties appreciate a lot, like, hey, if this property goes up in value $150,000, but rents have gone up $100 a month, the rents have not paced with appreciation. So if you do a maximum cash out refi, you could potentially have a negative cash flowing property. And it's more about, hey, we know that's a realistic scenario, so we put this max debt coverage ratio, and here's a rule of thumb, so that way we can run a scenario so we can find like a safe refi amount. Because if you do a maximum cash out refi and you're negative $5,000 a year in cash flow, you may not want to do a 75% loan to value. You may be like, hey, where can I safely have enough cash coming in to pay all the bills? And so we choose 125%, which means that for every dollar of new debt that Jenny could potentially take on, she'll have $1.25 in net operating income. So there'll be an extra 25 cents over every dollar of debt. So for cash out refis on investment properties, about 4.25 is what I've heard most recently. Do you have a more? This is about a week ago I've heard this, Jenny.
I don't have any other numbers for that.
So 30-year term for a cash out refi. And then for refi costs, this is just points. There's always some costs on there. But with that Fannie and Freddie update they did a couple months ago, we're definitely seeing a bigger increase in fees. So it's more around like 3% or 3 points right now. And if you were to sell it, as is, we'll just assume a 6% transaction cost to sell it.
Okay.
Now, for the new rental assumptions, what would you call a new market cap rate property? And again, this is assuming, to keep it very simple and apples to apples, keep it simple up here. So what's the cap rate for a property run at 8% in repairs? And again, you're self-managing at 0% property management.
Okay, so if we were to account for me as self-managing it, I would probably aim for high 4s on that, because I would probably just want to swap it into another single family home. So I would say 4.85 maybe.
4.85, okay. And then down payment, 25%?
Sounds good, yeah.
Interest rate, I mean, you'll probably be around, the 4% mark?
Yeah, I've seen some 3.875s this week, but we can do
Actually,
four
you
to
know
be on the
what?
safe side.
You're right. So I've got the same. When I got the lending numbers in the refi, I was told 25% down would be 3.875 with a 2 points in, purchasing or buy down. 30-year terms, we'll assume appreciation's at 3% and taxes are the same. So I'm going to zoom in on here and go to the summary tab now. And what this page does is this lays out all the options of what we can look at on the property. So it has 4 categories. The first one is keep it, which means if Jenny does nothing, how does the property perform? So with our assumptions we put in there, which are higher than your actuals, you're cash flowing about $4,600 a year, and your total return for everything for the 4 ways to make money is about $15,000 a year. So divide that by your equity, you're at about 12% return on your equity. So 12% on that locked in money on your property in there. Now, if you do a maximum cash out refinance, as much as you can up to that 75% loan to value ratio. And is that what you would do it towards? Is like 75% LTV?
I would, yeah.
So this would actually be cash flow positive, about $1,500 a year. Your total return would actually drop to $12,000 a year. But here's where it gets interesting. Your return on equity actually goes up 21%. And that's because rather than having, $100-some thousand in equity on here, you have a lot less on the refi. So you have a smaller amount of capital in the property. So therefore, you're getting a bigger return.
Mm-hmm.
So if that confuses anyone out there, think about a basic fraction. If you have 100 on the bottom and it's 50 up above, you're going to have 50%. If it's 50 on the bottom and 50 above, you're going to have a higher return. So even though it's the same number, you'll have a higher percentage. With all that, you'll be at like $55,000 in cash out equity. It says you'd be like 115% DSCR for your debt coverage ratio. But if you're cash flow positive, I don't know, I'd be fine with that. Would you?
Yeah, I would if I could find something better to put that 55K that I pulled out into, for sure.
So if we did a safe refinance, which the spreadsheet automatically runs, and this was going to take out less money to keep in more equity, you'd be cash flowing about $2,400 a year, but taking out about $40,000 in cash flow. So is the extra $15,000 in equity worth a difference of $1,000 a year?
I would say so.
I would too. So that option 2A, the max refi, and then the last option is sell it. If you were to sell it, what would you do? Well, you'd be making zero money from the property because you sold it. But after all the cost and everything, you'd have about $105,000 in proceeds from your property. And then kind of going forward down below, we are assuming that we're not assuming tax consequences on here. So I'm assuming you would do a 1031 exchange, right?
Yes.
So hopefully we would avoid capital gains now and defer those. But then scrolling down this next section, you're going to get to what happens when you buy the new rental property. And so all this does, it says, hey, you've got this cash, $55,000, $41,000, or $105,000 from those 3 scenarios, and it basically divides it by the cap rate of 4.85% at a 25% down payment. I'm sorry, 25% down payment divides it by to figure out how much property you can buy. Let me repeat, I said that incorrectly. Divides it by the down payment, not the cap rate, to figure out the purchase price. So it's a very simple, analysis of saying, hey, you're taking all this money and you're buying one property with the proceeds. So it gives you a good ballpark. So the maximum cash out refi would allow you to buy about $220,000 in a new property. The lower refi would be about $165,000. And the selling in 1031 would be about $420,000.
Could we try doing 80% LTV on the new property just to see how those numbers change?
Sure. Let me take a screenshot of this. So we're going to go back and change the down payment to 20%.
Mm-hmm.
And then now, we are seeing, and my screenshot disappeared. Read those numbers off while I find the screenshot, Jenny.
So with 20% down for the max refi, about $275,000 purchase price compared to with the 25% down, $220,000 purchase price. So that's more in line with what we're seeing as potential purchase prices for a single family home in this market right now. For the safe refi, we're looking at a purchase price of about $206,000 versus with 25% down, $165,000. Probably not going to find that anywhere around here. And then for sell it, that gives you quite a bit of latitude. Purchase price of $525,000 for 20% down, and with 25% down, $420,000.
So with a lower down payment, you actually increase your buying power by about $100,000.
Yeah, pretty good.
So then it calculates the net operating income, and it basically just takes the purchase price, times it by the cap rate to get the net operating income. And then it takes out the mortgage debt, and then it calculates the full returns on the property. Cash flow, appreciation, debt pay down, all of that stuff. So on the first scenario of keep it, it's all zeros because you've sold that property, so now you have nothing in that. But on the new property, you'd be making about $1,000 a year in cash flow, or about $15,000 on the new rental. And your return on investment is about 28%. Your cash flow on the safe refi is about $800. Your new return rental is about $12,000. And on the sell it model, the sell it in 1031, you're about $2,000 a year in cash flow, and your new rental would be about $30,000 a year in total return. So altogether, about 28% return on your money. And then moving down to this last section, this is where it adds the two scenarios together. If you keep the current property and then the new property you buy. So this gets interesting here. So on the keep it scenario, it says this will give you the best cash flow if you actually don't sell the property.
Mm-hmm.
So you'd be making about that $4,500 a year in cash flow, and your total return would be about $14,500. So it's the same numbers as if you did nothing with the property. Now looking at the other two, the max refi gives you about $2,500 a year in cumulative cash flow. And that's saying, hey, here's the cash flow from the new rental plus the cash flow from the existing property once we put the new debt on there. The safe refi will give you about $3,000 in total cash flow. Now the sell it in 1031 model would give you about $2,000 in cumulative cash flow, but your total overall return would be about $30,000. So the spreadsheet's highlighting a cash flow in scenario one of keep it of $4,500, but highlighting the scenario of sell it for your total return about $30,000. So no clear winner on here, what I'm seeing.
Yeah, I guess it's just a matter of what's more important to me at this point. Is it the cash flow, in which case just, leave everything as is, or do I want to kind of tap into some of the other benefits that real estate can offer? If we scroll up a little bit, I have to imagine that the majority of that 30,000 return is probably debt pay down. Appreciation. So yeah, I think at this point it comes down to really personal preference. There's no right answer to it.
And here's where we can play some scenarios on here, because there's a couple scenarios I'm going to play in the next 15 minutes we have on this podcast. So before we go back and actually increase the value of the property by doing those improvements or the cosmetic rehab, you said the market cap rate for a similar single family home is 4.85.
Yeah, if you can get a single family home for close to 5 with PM, that's pretty much a home run in this market.
Well, does this cap rate include a PM fee in here?
It does not, but I was assuming that I'm kind of upgrading in terms of, quality of the house as well. So assuming a lower return in that regard.
So what's the higher cash flowing property? A multifamily down there?
At this point, probably a townhome. I think is probably the sweet spot, I would say, in terms of cash flow right now.
What would the cap rate of a townhome be in May of 2021 that you self manage?
I think we could probably do like 5.2. We can do that. I
All
think
right,
that's safe.
5.2. We'll keep 20% down payment since you can do it on a townhome. So we increase the cap rate by about 4/10 of a point, which means that the property you're now buying is going to be a better rental. So you're still going to get better cash flow from the keep it model, but now the sell it and 1031 and trade up, your cash flow is now close to $3,800. So it's a lot closer to the keep it scenario, but you're making an overall higher return. So this would be buying, what if you had $525,000? This is 2 or 3 townhomes down there, right?
Yeah, 2 townhomes.
2 townhomes, okay. So if you find about a higher cap rate property, this now you're making better cash flow from selling it.
Yeah.
Would that change you? An extra $2,000 a year in cash flow?
For the amount of effort, I don't know. I think it's really borderline. Just because, like what I mentioned earlier, I mean, this property that we, currently own is such a set it and forget it. I hardly remember that we have it most of the time. It's so easy. So yeah, I think that the difference would have to be a little bit more substantial for me to go through the brain power of battling that.
I agree. I mean, there may come a time where it's like, oh my gosh, I'm leaving a huge return on the table. It makes sense because, hey, selling a property, getting a new property, especially when this is a solid winner for you, especially with the stress of a 1031, there is value to that. It doesn't show up in the spreadsheet, but there is value to it. So let's go back now and update if you can get a higher value on here. So we'll say $280,000 if you put in $20,000 of rehab. So I'm just going to come down here and add that to the selling cost of $20,000 to account for those costs in terms of selling it. Now, I'm assuming that you'd probably only put the money in there if you were going to sell it, right? Like you want to do that for a cash out refi.
Correct.
Yeah. So now what that does, if you were to put the money in there and sell it, your cash flow on the replacement property goes up to $4,500, which is $55 less than the keep it model. And then your overall return goes up to about $37,000. So, and that's if you're buying a new rental property. So your cash flow will be about the same compared to your current rental to the new rental if you do this upgrade. And then your overall return will go up some as well because you're buying, a bigger property or more expensive property. So therefore, you're getting more appreciation, debt pay down, and all the other benefits as well. So again, that's not a clear winner to me.
Curious if we scroll up what my cash out refinance proceeds would be in that case.
So your cash out refi proceeds, looking at the max cash out refi, you'd be about $88,000. However, now your cash flow is basically break even, negative $400 for the year.
Yeah.
So now since it's becoming a lot more valuable, but you know what? I did not increase the rents on here. Because you said it was $1,450 with the rehab, right?
Yeah, for sure.
So let me bump up the rents on here because that was the other thing I meant to do. Okay, so you still get the same amount of cash flow or cash out, about $88,000. But now your cash flow, the max cash out refi, is $1,700.
Oh, see, now this is probably
that becomes interesting.
More appealing to me. Yeah, for sure. If I get to keep this property, still cash flow, and now I have almost $90,000 to redeploy. That's pretty exciting to me.
Yeah. So if we scroll down now to get an updated cumulative section, which is we had the existing property that Jenny owns and the new townhomes that Jenny would buy. You can't look at the keep it model. The cash flow would go up because we increased the rents on there. And then the max cash out refi will give you about $5,000 a year in new income or new cash flow and about $40,000 in cumulative returns. And what gets interesting on here is now the spreadsheet, which highlights the highest cash flow model and the highest overall return. It says the highest cash flow is the keep it, and the highest return is the max out cash out refi or the max refi.
Yeah, with only really a $2,000 difference between the keep it and the max refi for the yearly cash flow,
Yeah.
for nearly $90,000 out of pocket or back in my pocket. That's pretty good, I would say.
So, but with a great tenant in place, though,
Yeah,
would you? How long do you think that tenant will stay there?
I think he'd stay there, quite honestly, as long as we keep rents reasonable for him. And I truly do think that there's a benefit to that. I think that we probably would not consider doing any of these uh, situations unless he were to tell us that he wanted to move out.
Yeah, and that's the
Yeah.
thing. Like, I mean, if you get a great tenant in there and it's minimal headache, don't
Mm-hmm.
kick out a great tenant and then spend
Yep.
$20,000 and have 2 months of vacancy, get a new tenant in there. Like, that's not worth it.
It's not worth it.
Um,
Mm-mm.
I mean, from what the 30 minutes of us talking, what my gut says is keep the tenant in there right now. Don't do anything, but potentially do a cash out refi right now if you want to pull out some equity, but in that as is model with no upgrades.
Yeah. Yeah. I think my gut is definitely keep it as is. No upgrades, assuming that this tenant stays, and consider doing the max refi.
Because that would actually probably, your interest rate would probably be about the same, right? Because your current interest rate's
Mm-hmm.
at 4.375.
Yeah.
So your interest rate should be about that or maybe even slightly lower as well.
I think it would depend on what the actual cost of my refinance would
Yeah.
be, if I would think that would be worth it in the long run.
Because I think it would be in the low fours would be my what sounds like right now for investment cash out refis. So about the
Okay.
same interest rate you have right now, 4.25, 4 3/8.
Okay. Hmm.
Okay, all right. So getting back to, I hope the listeners and viewers can follow all that on there. But this is one of the things that I mean we really enjoy doing. Jenny and I are both very numbers oriented and like the financial modeling. And I always find when we do this with clients, like I enjoy it and it's always fascinating because exactly what we did, Jenny, we went and talked a few different scenarios. You manipulate the spreadsheet and then you weigh in the headache factor, the factor of, hey, this property is a great winner. Is it worth touching it? Well, since you're getting, crazy appreciation down there, it's an easy tenant, it's low maintenance on you. Yeah, why rock the boat?
Mm-hmm. Yep. If it ain't broke, don't fix it. That's kind of
Exactly.
my motto for this one.
So what do you? So okay. So recap for us what you think your plan for this property will be.
So probably in all honesty, just based on like my current capacity to take on anything else in life, I think I will just keep it. Assuming and crossing my fingers that this tenant stays in place, I will just probably keep it and probably not refinance it, just due to I'm not really getting a better interest rate and I'm going to have to pay financing costs. I'm not really sure what, in its current state, that $50,000, if that's really going to do it for me to go through that process.
So I got a curveball question here for you because last couple weeks I've been researching HELOCs for my primary residence, and one of the lenders or one of the banks I talked with, it's actually the first bank I've talked to in a long time. They are still doing investment property HELOCs
Mm-hmm.
at a 70% LTV.
Yep.
And it was like right around like I think 4.5 to 5% interest rate. It was like prime plus 1.25.
Yeah.
So would a HELOC potentially be an option for this property? Or again, $40,000, whatever, would that be worth it for you right now?
So I actually have a HELOC on a different rental property with fairly similar numbers to this. And I don't know the ins and outs. I haven't really spent a lot of time researching it. But I do know at one point I pulled out the cash and I was going to do something with it, and my credit score took a crash because they're considering it revolving debt. So I immediately paid it back so that my credit score would go back up. So like if you're going to balance that with taking out a long-term loan, I would really consider talking to someone who would know more on that subject and get their opinion on how that will kind of come into play on your qualification.
And that's a great point. Before you start taking out loans, if you're looking to do a HELOC and buy at the same time, talk to both lenders and probably a few other lenders and be very specific into the order of operations. And I'm doing that right now because I was looking at the, getting this HELOC plan for later use and like, oh, I've got a few investments coming up. Like, oh, okay, which one do I do first? And I'm having that conversation with a lender later today. All right. So, Jenny, thank you for putting your property in because this is really interesting. This is a scenario I haven't quite seen so far in some analyses I've run, so I enjoyed it. And for our listeners out there and just, people live in Colorado Springs, if anyone has questions out there or existing rentals and you want advice or you want us to plug your property spreadsheet like this, reach out to us. We are more than happy to. And we truly want to give you hey, here's scenarios, here's advice. And, sometimes it's, hey, you should sell it, which obviously benefits us as agents. But a lot of times hey, you know what? I personally would keep it or maybe consider doing a refi, but keep it. Here's why. And we always try our best to put ourselves in your shoes and give you hey, real advice because we look at this as building a long-term relationship and helping you do things to optimize your portfolio. So if you have any questions or any properties that you want to run through to figure out if we should sell it, keep it, refinance it in the market, please reach out to me or Jenny. We are more than happy to do it. Jenny, any closing thoughts?
I don't think I asked you, what would you do if you were me?
What would I do if I were you?
Yeah.
I would keep this property for sure, just because it's simple and low headache. And then, doing a cash out refi right now, I may do it if that $40,000 or $50,000 would be enough to help me do the next property or investment I want to do. Just kind of depends right now on what's on the plate and what all my other capital is like. For that amount of money right now, I probably would not do a cash out refi though. Doing some quick mental thoughts. I would keep it, and then a year or two, or as the tenant turns, then I would reevaluate it. But if the tenant turns in 2 or 3 years, my guess is that's probably the time. Go in there, rehab it, sell it, and then 1031 it because these numbers would be a lot more exaggerated due to the appreciation.
I like it.
So yeah, I would hold it.
Awesome.
Do you
Thanks so
want to
much, Chris.
make me a partner in the property to continue giving you my opinion and advice?
Yeah, I don't think so. But
Okay.
I appreciate the offer.
Awesome. Well, Jenny, this was fun. I always enjoy doing these with you, so thank you.
Likewise. Thanks, Chris.
All right. Thanks, everyone. If you have any questions, please reach out. We're always happy to chat.